Welcome to the Real Estate Guys radio program and happy holidays. I'm your host, Robert Helms. As we wrap up the year, we're going to take a look at the current state of the single-family rental market and what opportunities may be available in the coming year. And we've got two great guests today on the Real Estate Guys radio program. Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2023 Goals Retreat, January 6th through 8th in beautiful Lake Las Vegas, Nevada. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the 2023 Goals Retreat on the first weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Our co-host, financial strategist, is here, Russell Gray.
Hey, Robert.
And we are in Phoenix, Arizona, Scottsdale specifically, for the IMN Single Family Rental Forum West. Now, that's a mouthful, but the good folks at IMN have been holding this conference for now its 10th year, and West is the West Coast, and they do one on the East Coast, and it's been an amazing 2.5 days. And what's really interesting is where this space has gone. That's going to be a big discussion, and more importantly, what's happening in the world of single family.
Yeah, you'd think that single family home investing would be very mom and pop, very millionaire next door, and over the last 10 years, it's really evolved. You've got funds involved, you've got technology companies involved, you've got people coming in with all kinds of metrics and data analytics. It's become a very sophisticated professional investment. And a lot of us, when we think about becoming a real estate investor, we're just like, oh, we're going to go drive the neighborhood, find a little house, buy it. What you need to realize is every day, every week, every month, every year that goes by, you're competing with these big, well-funded, really professional players. And it doesn't mean there's not room to play. In fact, in a lot of ways, the reason we come to conferences like this is not so that we compete with them, but we can see what they're doing. We say all the time, one of the ways to pick a market or follow a trend is to follow the big dogs. You look at what the people who have the big research budgets and the big sophisticated teams and access to all the data, and you look at what they're doing and where they're going and what they're thinking and how they're communicating to their investors and the analysts, and you can get a lot of insights and learn a lot in a short period of time. So it's been a great conference for all those reasons. It's always fun to come, and I've learned a lot so far.
We don't attend every year, but we've attended, 4 or 5 of this particular version, and IMN does a lot more. We'll talk about that before we're done. But I think it's the big change. In many ways, the institutionalization of the single-family marketplace has really taken place in these last 10 years. And just for some context, one of the things we heard on a panel was there's approximately 16.5 to 17 million rental homes, depending on who you listen to. So that's about the number of for-rent single-family homes in the United States, and less than 500,000 of those are owned by institutions. So we all heard about the hedge funds that came in and bought up all the property. Well, that happened, but they sold a lot of those properties. And now we're at a pivotal point where we're starting to see true institutional money come into this space like never before. Now, to break with tradition, rather than you and I just talk, we've got a couple of guests with us today who have been at the conference that are probably not unknown to our listeners. But first, on the finance side, let's say hello to our favorite mortgage professional, Stephanie Riley. Hey, Steph.
Hey, guys. It's good to be here.
It's good to have you here. I was amazed in the exhibition area just how many lender and lender-related companies were here.
Absolutely. I think it's interesting to see the evolution in the single-family financing space. You think single-family, you think conforming Fannie Freddie loans.
Right.
But No, there is so much depth of capital markets and money looking for yield coming in on the debt side in the single family space. So yeah, lots of options for financing.
And with what's happened with interest rates in the last several months, we'll be talking about that for sure. Also, the president of Bekam Investment Group, our good friend Sep Bekam, who I believe told us about this conference all those years ago. How are you, Sep?
Hey guys, I'm good. Good to see you again.
Nice to have you up there on stage where you belong on a panel today. So that was great too.
Thank you.
And Russ and I were on a panel. We was going to be one of us, and then Russ did a very clever thing. He said, "Well, I could be a guest, and the guy who was going to be the moderator, you could actually be a panelist. And we could have Robert moderate, and that worked out great. That way, both of us got on a panel today. But we came more to listen than to talk. And Sep, you've been at this conference a lot, and have you been to the East Coast one as well?
I have, and that's over in Miami.
Yep. Okay. So give us your perspective on, before we get to what we specifically learned this week, kind of the way this space has evolved from the first time you came, a lot of mom and pop investors, to now all the suits.
Yeah. So the first one I came to, that was in 2015. It was here in Scottsdale, and it was very different. I've come to most of them ever since. Back then, the hedge funds were still buying existing houses from the great financial crisis. The development arm, it was in the early age as far as like the build for rent. So that's back in 2015. And over the years, back then, existing build was more popular, build for rent was new. Today it's switched, where build for rent is more popular and the existing is not as popular for the hedge funds. Basically, for the hedge funds to go in and to buy a community of homes, it's a lot easier for them to deploy the capital and buy 100 houses or 200 houses new at once, lower maintenance cost. You don't have the headache of inheriting all the tenants. Compared to before, when they were buying 1 or 2 or 3 houses every hour from the courthouse steps, from the banks, in foreclosure, then you had all the rehab that was associated with it. So for them, they tend to gravitate more towards the build for rent, but some of them still do the scattered build.
Well, this is a big topic. We've been covering this, Russ, for quite a while. You remember back years ago when Warren Buffett said, "Man, if I could, I would buy 200,000 single-family houses." And everyone said, "Yeah, but you can't." Well, what's happened is folks have figured out how to do this. And to your point, Sep, rather than buy one here and one over there and one in the neighborhood across the way, they're creating neighborhoods. And this is a really evolving space.
Well, I think one of the things is just understanding the economic cycle. Back then, you could buy inventory below replacement cost. For that reason, nobody was building new inventory. That really wasn't an option. What had to happen was all of the distressed inventory had to be absorbed. The big players recognized the opportunity to be in the space, and they had to go in the door that was open. And the other thing is they didn't know what they were doing. And, we laughed at them because we were all in the street. Hey, these big Wall Street guys coming into our play yard. We're like, God, these guys are overbidding. They don't know what they're doing, blah, blah, blah. They're going to get their rear ends handed to them. But they're smart and they have a lot of resources and they figured it out. And then eventually, effectively, between them and Main Street, we put a bottom in the market. And people did what they continue to do, and more housing was needed. And as housing came offline, this is an important lesson because past is prologue. When you couldn't build because of the great financial crisis and the need for housing continued to expand, somewhere down the road, it was pretty obvious we were going to have a supply-demand imbalance. Prices would move up, and then new building would be able to come online. And when that happened, it would pull up all the existing inventory's prices to match the current amount to build, right? So that's kind of a basic premise. So these guys all benefit from that. They help make that happen. And now one of the things we've noticed is that we've kind of come full cycle. Now we've got rising interest rates. We've got talk about, hey, prices are moderating, but they did have to make the move towards build to rent. And now the question, as we know from having talked to some builders, Robert and I did a show on this some time ago, talking to a couple of builders who had to take their foot off the gas, right? They've had to take their foot off the gas because the future's uncertain. So a big part of this conference for me is being able to look back on the things that I learned 15 years ago and what it felt like in the lead up to the great financial crisis, what it was like to go through the great financial crisis, to come out the back end of it and see what's gone on the last 10 years and realize with rising interest rates, it's not exactly the same, but it has some similarities. And so it's really interesting to hear how these big grain people who are now on the front end of that same experience are starting to think. So maybe we can talk a little bit about that today.
Well, I think it's an important part of figuring out where we are. If there is an attraction, if there is a place capital will go where it's loved and appreciated, then eventually the folks with a lot of capital are going to go there. Sep, you work with some private offices, family offices, folks that represent fortunes, and yet they're not really deploying it. They hire people who do, and they look for these kinds of opportunities. And in many cases, they're right in this space now because they're starting to see it. But Steph, the lending on this has changed. To your point, it's not just, this lender or that lender. There's so many different spots here. And before we talk specifically about what you learned this week, I think there's an important point, and that is, listeners to the real estate guys, like you're probably thinking, okay, well, if there are developers that build specifically for tenants, I'd like to own some of those. And thankfully, we know several folks that do that and sell that inventory to individual owners. But there were lots of funds here who build the properties, rent the properties, and keep the properties. So that's their economic model. So we're all in the same pond, if you will, but there is opportunity. So don't hear this and think, well, it's only these big funds that can make money. It's not. So, Steph, let's talk about the financial part, because it's completely different if I want to buy a third rental property and qualify, and it's a single family home, than if I want to put together a subdivision of 75 single-family houses that aren't going to be sold to owner-occupants, but are going to be sold to renters.
Yeah, it's a great point. I think with the lending, the financing, you have to understand that when you're looking at what you're talking about, commercial debt, right, to an institution or a fund or a company, that debt typically is not what you would think of like a 30-year fixed rate.
Right.
Oftentimes that's adjustable debt, heavy prepays. And so the ability for them to stabilize something and being able to count on the cash flow or being able to exit or refi at the time that they need to, they're quite a bit more constrained on the debt and the equity side. If they're raising capital, that equity has a timetable, has a return, has a time that it needs to come back to the investor. On the debt side, same thing. That debt may have a balloon payment, may have a phase where it adjusts, may have a prepay if you want to get out early. And so a theme that I picked up on at this conference from just about everybody is the focus of analyzing their portfolios and the debt structures is top of mind to make sure that they are planning ahead for what they're going to do if interest rates continue to rise or if they pull back, and making sure they can stabilize everything in the interim.
There were lots of topics that seemed to permeate throughout the whole conference, and obviously interest rates is one of them. The very foundation of single-family property, whether you're going to build a development of 300 houses or you're just going to buy that next single-family house in your portfolio, when interest rates go up like they've gone up, it's had a huge impact. So talk about, either one of you, what you guys heard as far as what these big funds and individual investors are doing about that.
Yeah, so I've noticed, I sat on a couple of the owner sessions where it's limited to just, you own a portfolio of rental properties, either large or small. I noticed that a lot of the built for rent owners were or investors, they were a little cautious on it. They're like, we don't know, what is our exit interest rate going to be? What is our exit cap rate going to be? I didn't see anyone saying, oh, everything, the sky is falling and everything's just going to crash tomorrow. But I think there's just a little bit of concern just because there's not as much stability on the financing and all that, or I should not stability, predictability, right? They want to see just a little bit more maybe time to pass through. As far as on existing build overall, and I saw a couple of the panelists just survey the audience informally, how many of you, raise your hand, are you going to buy properties in 2023? And multiple of those panels, 80% of the room was raising their hands. So it's not as optimistic as maybe 6 months ago or a year ago or 2 years ago, but people still see, hey, inflation is happening. There's still opportunities. The vast majority, I think they were under the notion that there's going to be way more opportunities coming up in the next 2 years compared to where the last 2 years, the last 5 years.
I think one of the themes that came up along those lines is just what always happens in any recession. Think about your own personal life. If your pay goes down, if you lose your job, if you're on commission sales and all of a sudden your business is slowed down, you begin to go over your budget with a fine-tooth comb. You begin to look for areas to improve, to cut back, to be more efficient. Companies, industries do that. The gold industry had to go through that. When the gold price was suppressed for quite a while, it got up to like 1900 and something in 2011, 2012, whatever it was, and then dropped all the way down to just under 1100. Those mining companies really had to tighten their belts. Well, it's just what's going on right now. These people are saying, hey, we need to be in the business because this is our business. We're going to continue to buy. But the term that we were using, what did they say? They were going to shrink their box or whatever.
Their buy box.
Their buy box was going to get tighter, and they were going to go back and look over their operations. Kenny McElroy did that. He told us the same thing. When they're in aggressive acquisition mode, when the market's on fire, when money is free, when rents are going up willy-nilly, you're just grabbing as much as you can. But when it slows down, then you don't keep buying into the storm. You're pickier about what you buy. You still want to buy, but you're spending that excess time to take the opportunity to go back, review the portfolio you built, review your capital stack, make sure that your debt is properly structured based on what you think is coming. Make sure that your operations and your rents are where they need to be, because you're just getting prepared for it not to be as free and easy and as liquid as it used to be. There's not as much liquidity coming in through the credit markets, and there's not as much liquidity in the general marketplace. So professional investors will still continue to invest. Mom and pop investors, they've slowed way down. And when you're talking single family homes, you can't ignore the mom and pop investor, and you can't ignore the homeowner, because they're all part of the process.
I think that you had a great point about the buy box, right? That was talked about a lot. And one of the things I took away was, another thing that was talked about was the data and the analytics, right? So these institutions, they have a ton of capital, and they are really studying this space, and they are watching the data, and they are honing in on their buy box. And one of the things that came up as an opportunity for the individual investor, the smaller syndicator, is if you can learn what they want and where they're going. We have the fortunate position to be quite a bit more agile than they are, and be quite a bit more connected on the street, boots on the ground. And so one opportunity that was discussed was to kind of get in ahead of them and be there to take advantage of the big money coming in behind you and pioneer into the markets. Another thing that came up was, this is not, real estate is obvious to all of our listeners, but real estate is local, local, local. There's no nationwide housing stats that you're going to look at and give you direction. And once again, therein creates a huge opportunity. If you have the ability to get local and be in the right spot at the right time for the buy box that big money is hunting for, I think there's a huge opportunity to pioneer and win big, knowing where this money's seeking to be.
Yeah, for sure. It's like wholesalers, right? They go out and they are on the street and they dig up deals, and they maybe don't have the wherewithal to hold the deal or even to buy the deal, but they step aside and somebody else comes in and takes that over. It's the same thing here. There's that opportunity. And I think that's what's interesting, is you've got these institutional folks. To your point, Russ, they have to deploy capital. They aren't like mom and pop who say, well, we could wait a couple of years to buy our next property. These institutions, they really can't. One of the questions that came up today is, well, if all this money's on the sideline, what is it doing? And the panelists said, well, it's actually not all on the sidelines. They are looking to put it to work. But to your point, Steph, that the analytics and the intelligence today is more than we've ever seen. So because this space has matured, you've got these companies whose business it is to help these people take information and make their decisions.
Well, coming back to Stephanie's earlier observation, or I think, Robert, it was your observation, one of the two of you mentioned that there's so many lenders on the floor. And we can look at that and go, oh, these are vendors, these are providers, and they're eager to come in. But really what they are investors. And what it's showing me is that there's still a lot of interest in the space, but there's a lot of interest in the space on the more conservative side of the space. You know, if you go back to just financial planning 101, it's like when it's risk on, when everything looks good, you buy stocks, and when it looks scary and you want to be conservative, you buy bonds. When you get older and you don't have as much time to recover or build your capital and you need to have that current yield and safety of principal, you buy bonds. Well, debt in real estate is like bonds, and real estate, or the equity side of real estate, being the owner, is like stocks. And so that mentality of how you manage risk and when you move in and which side of the capital stack you want to be on. And what I saw with all of these people in the lending space is there's money out there that wants exposure to the space, but they want to be in a conservative position.
Yeah, and also one thing that was talked about on that point is when you're looking at cap rates and then you're looking at yield on bonds backed by the same real estate, it kind of makes you think, why am I playing on the equity side?
We're talking today about what's happening in the single-family market. We're in Scottsdale, Arizona at the IMF Annual Single Family Rental Forum. When we come back, you're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did. For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since, when there are concerns about the quality of the currency, alert investors seek shelter in silver and gold. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Everything you always wanted to know about silver but didn't know to ask. Featuring 30-year precious metals veteran Dana Samuelson. Send your email requests to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, just about in our 27th year of broadcasting. We're in Scottsdale, Arizona today, and we talk about all kinds of real estate here on the show, but not as much single family as some other podcasts. And today we are at the IMN, that's the Information Management Network, although no one calls them that anymore. IMN does a series of conferences on all different real estate and non-real estate, actually, topics. And for 10 years, they've been doing this single family rental forum here on the West Coast and the East Coast. I guess they consider Scottsdale the West Coast, but it's the west part of the country. The one in the East is done closer to the water in Miami. But we're talking with Sep Bekam and Stephanie Riley, who have attended this conference. And I think there's so many different sessions and seminars and a lot of panels that we could talk about. But today you were on a panel, Sep, and you guys were talking about how are you changing your operations based on what's happening in the market. Obviously with interest rates, but also with what's happening with tenants and incomes and all that kind of stuff. Share with us some of the highlights of that panel.
Going into that panel, the thing that was on my mind was a quote from you, Robert, where you say you can make money in any real estate market cycle. You can make money when times are good, when the economy is going up, when times are flat, and when times are going down. And if anything, when the times are going down, that's the best time, right? That's where it becomes a buyer's market. You find the distressed sellers. You're not having to get in bidding wars. The deals end up making more sense for you and your investors. So going back as far as like the topic of today's panel is as far as acquisition criteria. How is your acquisition criteria changing now compared to before? And on the panel, there were some built-to-rent developers, property managers, brokers that sell portfolios of rental properties to these hedge funds. The big thing that's affected us is with the interest rates is the cost of the capital. When we do the refinance, it's almost twice as expensive now compared to 6 months ago. So the payment has doubled, where our tenants' income has not doubled during that time frame. And you guys know we focus more on affordable housing. A lot of these tenants aren't even getting raises, right? Inflation is still happening to them. Cost of living is still going up. Cost of food is still going up. Cost of energy is going up. So there's an opportunity, I think, if the rent isn't doubling, if it's staying a certain rate in your local market and the cost of debt is going up, then the prices have to be affected from that, and that could lead to some opportunities.
Well, you know what's really interesting about that, Sep, and you didn't mention, but maybe you should. How many properties are you managing?
So, well, before I came to the Real Estate Guys as a syndication seminar, I had 2 fourplexes, and now we have about 220 houses nationwide.
Okay, so nice plug for the Secrets of Successful Syndication. Send an email to syndication@realestateguysradio.com, and we'll teach you how to become Sep Bekam. But I think the thing about the rent is that normally you'd say, well, there's a housing shortage. There's not enough affordable housing. And of course, that would cause the price to creep up. But you can only pay what you can afford to pay. And so when you have inflation taking away the effective purchasing power from people that really don't have savings or assets on their balance sheets that are going to be the beneficiary of inflation, they can only use so much credit to subsidize their income until they don't have any. And we know that real wages have been falling. I think I read a stat the other day that there's some, I don't know if it's a record, but it's a very high percentage of people that are behind on their utility payments right now. So it really hits Main Street, especially when you're in the affordable family space. So that becomes a challenge because you're really having people from above in the middle class that are coming down into the lower class, and the people that are the lower class getting pushed completely off the bus. And are you seeing some of that in your portfolio and the markets that you're working in?
Yeah, and you guys have mentored me as far as paying attention to who is it that you're serving, right? Whether if you're a syndicator, you're serving your investor, right? It's not about you, it's not about the deal. Well, the same thing, at the same time, it's with when you're investing in property, if you're doing Airbnb, who's the vacation renter who's renting your property? Is there still demand for it? If you're doing multifamily, whatever it is, just what are the demographics like in that market? And you used on your guys' panel the analogy of the Bakken, right, where there was a need for housing, but it was a one-trick pony town. Well, for us, the need on the affordable housing comes to when we have a property that's repositioned, is there going to be a tenant that's lined up to rent it? And the demand for that is still very high. I mean, right now we're doing this recording in the winter, and it's generally slow season, but we're still renting the houses. So we're still getting feedback from the property managers, from the leasing teams. If they said, "Hey, there's no tenants available," then that would fundamentally change the business plan. But when the monthly payment of a mortgage is doubled now compared to a year ago, there's fewer home buyers and there's more renters.
Which is one of the big picture takeaways of this show. So it may sound negative that interest rates are up and less people are buying houses, and we're seeing prices fall in certain markets because of that demand imbalance. But for folks who own rental homes, it's good news. More people have to rent, whether that is a mom and pop or an institution.
Yeah. The other thing too, so what IM was a big help with is when I first came 7 years ago, I was on the impression, okay, you only have Fannie and Freddie and you're limited to 10 rental homes on your personal name, right? And if you get lucky, you can get a loan from a bank. Well, if you've ever invested out of state and have tried to work with a bank in the market where your property is, it's very challenging. Even if you're doing a better job than the slumlord that you purchased the property from, the banks want the owner of the property, they want the owner of the LLC to be local in the market. Well, what's happened with the institutional investors who come into the space is that they've created lending companies. You've had life insurance companies come into this. You've had pension funds. Like, there's a lot of capital on the debt side of it. Not only are they lending to the institutional investors, but they're lending to mom and pop investors like us. And I know Stephanie has a lot of access to those types of lenders, and it's been a big help because it's not like having to go and get a blood test, where they ask for everything to get a loan done. It's they understand what the investor needs, and they can provide the financing and liquidity so that we can spend more time on the providing housing for the tenants instead of going through the whole underwriting process.
Well, Steph, when we first started working together, it was easy for anyone to get a loan. I mean, you had to have, I think, a pulse, and maybe that was all. But it's changed a ton. Talk about that, how because of what's happened in the last year and years, that the underwriting criteria has changed from the lender's point of view.
Yeah, well, again, those conforming loans now, in the wake of all of that great financial recession and all of that, tightened quite a bit. And in order to get that kind of financing, you have to fully document. If you're self-employed, you got to produce tax returns, the whole thing, and it is a little like giving blood. So that has definitely tightened. But on the other hand, where that credit market has tightened, it's created an opportunity, to Sep's point, for these other institutions and investors to come in and create a whole nother capital pool for these loans that in a lot of ways, some of the products that we had before are coming back. So, Sep, you mentioned these lenders that will lend non-conforming to the individual even, and you can get a little rental property with a commercial loan on it that you don't have to have any employment, you don't have to have any income, and as long as that property, not even cash flows today, you don't even have to lease, as long as the market rents in that area would support some level of cash flow. And when I mean some level of cash flow, they're even willing to accept negative cash flow at these points in the game, and they will still lend with interest-only options and things like that. So yes, it's a completely, almost like full circle. And in some ways, that whole feeling we all talk about, oh boy, feels like 2005, 2006. In some ways, that rush of capital into the space is definitely there stretching.
But the difference is this time is that's not capital that is looking to speculate on Wall Street. In other words, those guys are coming in because, they're in search of yield and they want to have exposure to the space. They're actually a little bit bullish, I would think, if they're willing to do that. Because, right now the Fed is selling mortgage-backed securities, not buying them. And the bond bids aren't what they were, right? Everybody was just frothing at the mouth to buy mortgage-backed securities back pre-2008. That's not the case today. So people do want to have productive assets, and a productive mortgage with a decent yield is a productive asset. And when you can't buy bonds because there's just not enough of them or they're not yielding enough, then you've got to go someplace else looking for those yields. And of course, they're finding single-family homes, just like they did in 2006, 2007. But I think the back end is a little bit different. We're going to see. I mean, nobody knows what goes on in the plumbing of Wall Street, but it does seem that there's more of an interest.
We're talking about the current state of the single-family rental market. We've got more, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, then join us next summer. You'll spend an entire week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all begins June 6, 2023 in Ambergris Caye, Belize. Visit realestateguysradio.com and click on the tab that says Summit to learn more and reserve your spot. We'll spend a sun-drenched week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. It's nearly 70% full already, but there's room for you if you go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 21st Annual Investors Summit on Sand.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. It's the most wonderful time of the year. We're talking about the changing opportunities in single-family rental homes today with Sep Bekam and Stephanie Riley. Hey, there's just a minute left for you to get signed up for the 2023 Goals Retreat, Create Your Future. Happens the first weekend of the new year in Lake Las Vegas, Nevada. Get all the details at goalsretreat.com. That's goalsretreat.com. Before we get back to our discussion, it's time to play Real Estate Trivia, your chance to win a prize. By knowing today's Real Estate Trivia question, as soon as you hear the question, think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Send us your name, the answer to the question, and your mailing address, because the first person that gets it right gets this awesome book, Success Habits of Super Achievers. More than 80 authors with incredible inspirational stories. You're going to dig it. That can be yours if you know today's Real Estate Trivia question. Last week on the program, we had championship NBA coach Kevin Eastman with us. We asked this. Kevin spent 3 years as head coach for Belmont Abbey College. In what state is it located? Well, Belmont Abbey is in Belmont, North Carolina. Here's our Real Estate Trivia question for this week. Which U.S. state has the tallest people? Yeah, think about it. On average, one of the states has to have the tallest population. It changes year by year. For 2022, which U.S. state has the tallest folks? If you know or just want to guess, send your best guess to trivia@realestateguysradio.com. We'll need your name, the answer to the question, and your physical mailing address. First person that gets it right gets Success Habits of Super Achievers. That's today's Real Estate Trivia question. We're coming to you from Scottsdale, Arizona, and we're talking about the single-family market. We're at the IMN Single Family Rental Forum West, and lots of great stuff today. I listen and I'm thinking, where is the opportunity? Sep, you're a fund manager. You raise capital and you deploy it in assets like single-family homes. In fact, that is your specialty. So talk about where you see some of the opportunity, because I know Russ and I were talking about, it seems like there's a great opportunity to raise capital for all kinds of different things in this space.
Yeah, again, what I appreciate about you guys are asset class agnostic. So when I first met you guys, I was all in onto multifamily, and I realized my true passion is on affordable housing. A lot of great multifamily investors out there. You guys have taught many of them, including myself. Not that I'm saying I'm a great multifamily investor, but as far as on the affordable housing, what I liked as far as single family is that you have multiple exit strategies. We can go buy an affordable portfolio of 100 houses, and we can sell off one at a time. We can refinance one at a time. We can refinance the entire portfolio, versus if it's an apartment complex, you can't really do that. You can't sell the middle unit, right? If you've read Creature from Jekyll Island, if you listen to the Real Estate Guys podcast, and if you're skeptical that maybe the CPI is not 100% accurate, maybe inflation is higher than that, Russ often talks about the arbitrage. If you could borrow at one rate and you can invest it elsewhere. Well, on the panel that I was at, there was a question that came in at the final minute, and it said, and it was an anonymous attendee in the audience. It said, hey, I have access to 4% money. It cost me 4%. What should I do? Should I invest it in single family, affordable? Should I lend it? And I was like, oh, this would be a great question for us. And then we had to end the panel.
Well, and this is a really good point, because I think one of the categories that you should understand that was very clear from listening to these panels is there are scattered lot single family investors, and you do a lot of that, meaning that you might have 30 single family homes as part of a syndication where you've raised a group of investors, but they're located throughout a city or a couple of cities. They're not contiguous. Versus when we talk about build to rent or build for rent, what we're talking about is a neighborhood of homes that are right next to each other. So it's 100% tenant based. And with the scattered lots, there are all the nuances of everyone's different, built at different times, different amounts of CapEx, etc. Whereas these institutional thinkers are like, well, I'm going to just build 100 houses. In fact, to the point we had before the break, there was one of the guys that said, it was easier for me to get a loan for 150 houses than it was to refi my personal residence. So to your point, Steph.
Exactly.
Right? But this is a great question. Like, I have access to capital. What can I do with it?
Yeah, especially, and that access to capital, I think that the member who was asking that was some type of institutional investor where they had access to cheap capital. And I heard a couple other attendees were like, yeah, they said they have a family office, or they have a pension fund that they'll lend them money at 5%, and they're lending it at a higher interest rate than that. So a lot of them want to be on the debt side of it. But going back to the whole, the inflation concern, are rates going to go up? Or are they going to go down? Are values going to go up? Or are they going to go down? One of my favorite quotes from your father, Bob Helms, was Bob was investing for 7 different decades, and he had seen interest rates, much higher than where they are now, much lower. And he said, anytime the interest rate is a single digit, take it.
Right.
So the neat thing with the financing in this particular space is that you're not limited to the 10 homes. You can talk to Stephanie. You can get a 30-year loan. It's pretty certain that people are still going to need a house, right? There's no certainty as far as what the value is going to be, but as long as it can cover your mortgage and you can cash flow it, then over 30 years you have a paid off property, right? And likely, unless you're in a market where all the jobs have left, Detroit, Flint, if you're somewhere where it's more, capitalistic, then you're probably going to have some appreciation along the way as well. So
it's another one of the big picture points is that we are underbuilt as a nation. NAR says we're underbuilt by 7 million units. Danielle D. Martino Booth says no, more like 1 million. But whatever math it is, everyone agrees that we need more housing. And yet, there's less demand for housing from the purchase side by individuals because of the affordability and interest rates. So back to our premise that, more people need to rent, that's good, but we're also underbuilt. So if we're underbuilt, absent every other economic indicator, we're going to need either more units or people are going to pay a premium for units. So that's on the positive side. But I want to come back to something you just said, and you said it on the panel. It was great today, Sep, and that was, so many people are saying, well, wait a minute, if the cap rate is 5 and interest rates are 7, it doesn't work. Except you talked about the actual inflation rate, meaning not just what CPI says, but in reality, when we go to the grocery store or we try to buy anything, it's a lot more. And Russ, I think this is a big arbitrage question, is at some point, the rate's too high from a mortgage perspective, or is it?
So true arbitrage is where you are using a same or very similar vehicle. So arbitrage isn't going out and taking money out of your credit card and then buying Bitcoin and hoping it goes from 1,000 to 60,000, right? If that happens, good for you. But that's not really arbitrage. Arbitrage done properly is almost risk-free. And so, for example, if you were to borrow money for 30 years at 4% fixed, and you could turn right around and lend that very same money for 30 years at 8% fixed, then you're both a borrower and a lender. You're in similar instruments, and you are at a positive spread. That's arbitrage. Now, there's variations on that theme, and what the real secret is understanding risk-adjusted return. And anytime you make any investment, you have to understand the risks that you're taking. And so there were some panels where we had some discussions about that. One of the panels that Robert moderated and I sat on was the one about, are you getting paid if you move into a secondary or tertiary market in order to take a risk? And, you could make the argument, hey, I'm going to borrow money out of an inflated primary market and invest it into a lower priced tertiary market. That would be kind of a form of arbitrage, if you will, right? But the key is what you have to do is you have to understand that what is your actual cost of capital? And then what is your actual risk-adjusted return on what you're choosing to deploy it? And then to me, because this is the nature of this space, we're not paper pushers. We're not dealing with things that are just out there somewhere and we're hoping they move one way or the other. We have a lot of control over what happens on our properties. We get to pick the managers. We get to set the policies. We get to make decisions about capital improvements and what we think the market is going to pay for those capital improvements. We have a lot of control. And I think that when you think of risk, a typical investor who's underwriting, a paper asset investor, they don't think about control in their underwriting. They don't even think about it because to them, they don't control anything. It's all speculation. It's all trying to predict what the Fed's going to do or what the market's going to do. But for us, we can have some control over what we're going to do. So there was a lot of these different types of conversations going on. How are you underwriting? What are you doing to adjust sources of capital? I just think that before you get too excited about going out there and doing an arbitrage thing, just make sure you understand what arbitrage is and that you're dealing with it based on risk-adjusted return, and then really realize how much risk you can mitigate. Even though the risk exists, you can mitigate a lot of it because you have a degree of control.
I think one other thing I see investors considering when they're talking about adjusted returns, and even though we don't let the tax tail wag the investment dog, tax-adjusted returns is another thing that big money thinks about, because big money often has big tax problems. And so as an individual investor, a wealthy individual investor, maybe a business owner, one of the motivations to find real estate is tax, quite frankly. And so that's another thing to kind of adjust, where you're talking about, Sep, the interest cost is 7, but my cap rate's 5. Yeah, but have you factored in all the ways that we make money in real estate?
And the big funds, that are doing, they don't think about it because they're not structured in such a way that their investors can get that. And so as a mom and pop investor, as a small syndicator, if you understand your own or your investor's tax situation and you craft your deal in such a way to harvest those tax returns and point them at the people that can use them, that's real money. That's real return. And it gives you a competitive advantage against the bigger players who just can't factor that in, because it doesn't apply in their situation.
It's a great point, because there are a lot of people that choose real estate because of the myriad tax benefits. I was just at Tom Wheelwright's Wealthability Summit, and he invited me to talk about real estate. And at the beginning, he goes, you guys are used to hearing me talk about tax, and we're not going to talk about tax today. We're going to talk about different types of investment classes. Annie Tanner was there talking about paper assets, and I was there talking about real estate, and our good friends, the Maselli brothers, were there talking about oil and gas and so on. And of course, Tom can't help himself but talk about tax. But everyone was in the room because they're trying to fix their tax problem or be more tax efficient. We're talking today about the single family rental market, and we've got some more thoughts when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, this is Peter Schiff, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning in today. Hey, if you ever wanted to do bigger deals using other people's money, or you wanted to get on some of these big investments in single-family tranches, then coming out to the Secrets of Successful Syndication. We do it twice a year. The one coming up in March is in Dallas, Texas. You get all the details on the website at realestateguysradio.com under events. We've got Sep Bekam and Stephanie Riley with us, and we're breaking format a little bit. We're just all having a conversation around the table because we're kind of jazzed on what we've heard here at the IMN Single Family Rental Forum in Scottsdale. And I think that another interesting thing about the single family space is its flexibility. So we had several folks who own single family homes that aren't necessarily the traditional home. build to rent is that. Instead of a neighborhood where organically mom and pop either keep a house and rent it out or buy a house as a rental property, these are entire neighborhoods that are meant as tenant-occupied property. But also, there was a panel on short-term rentals, specifically vacation and shorter-term rentals, and that's a fascinating use. Russ, you sat in on that panel.
I did, and it's really interesting. There's a couple of things. Since prior to the break, we talked about tax. And with tax, you have two different buckets. You have your passive income bucket and you have your active income bucket. And your passive income bucket is where you get to take your passive losses, like from your depreciation. So in some cases, if you're not a real estate professional, you can't use those deductions as effectively as if you can, and they don't count against your active income. But there's some investments like residential assisted living and short-term rentals that are considered to be active income investments, but they have a real estate component. Now all of a sudden that depreciation comes in to focus. And so that's one aspect of it that I think is interesting. The second thing about short-term rentals is you're catering to a different demographic. You know, Robert and I have been talking about resort property as a way to derive rents from the affluent. Short-term rental is basically the hospitality or resort business. If you look at the last jobs report, where were all the jobs created? In hospitality. And so that's been a kind of a strong area. And you've got people who, are being hurt by inflation, who are in the tenant base that, except in your world, right? The affordable housing, that's tough on them. But the people who have stock portfolios or appreciated real estate or whatever, I mean, they're feeling it, but they're not feeling it that much. And so instead of that trip to Europe or that trip to Hawaii, maybe they're just doing a staycation in a short-term rental. And of course, you have the business travelers that are saying, hey, I'd rather stay at a home. And the whole short-term rental thing has become a thing. It's like, remember back, it was like, I would never drive in some private car. I'm always going to take a taxi. Well, today I see the whole taxis, they're all lined up at the airport and nobody's taking them and everybody's on their app standing by the curb waiting for the Uber or the Lyft driver. So as things change, I think people are beginning to understand this idea, and institutional space is coming in and recognizing, hey, this is a place where we can go, where we can get the yields that we need that aren't as readily available in the traditional single-family home rental space. So there was a lot of enthusiasm from the bigger players that I heard speaking about the short-term rental space.
And likewise, on the debt side, the same thing. The evolution of the understanding of that space is getting there, where the capital is coming in and saying, okay, now we have a set of underwriting guides that we're comfortable with to validate the source of income for these short-term rentals. And also on the insurance side, we're seeing different, there was a vendor here that was talking about their specific insurance policies for short-term rentals. So it is becoming, to your point, Sep, earlier about how as a new niche becomes more understood by the market, now you've got lenders, you've got insurance, you've got capital, you've got support and kind of legs under it to actually get some traction and growth.
Well, as we wrap up, it's interesting to see single family rental, which was the mom and pop asset, actually grow up and become interesting to all kinds of companies and vendors and suppliers and institutions and REITs and insurance companies and so forth. So we'll continue to watch this space for sure. I think it's important that everyone understands it's not right or wrong. It's not that these big institutions and hedge funds are bad or doing awful stuff. It's quite the opposite. And Sep, I know you and I had this discussion that everybody in the ecosystem serves a very valid role.
The analogy that comes to mind is plasma TVs. I remember when I first saw plasma TV, I think it was like the late 90s, early 2000s, and it was big and had this box that was attached to it on the ground, and there was a cable connected to it. It's not like what you see at Walmart or Costco today for a couple $100. It was $20,000 back then. This is 25 years ago or so. But someone had to buy it, right? Someone bought it, and it was a wealthy person who bought it. Tells his friends or her friends, they bought it, and then when more people bought that, it became in demand. The producers of the TVs, there were more producers, more manufacturers. The prices came down where it's a commodity, right? even our tenants that are struggling with inflation, they have huge TVs bigger than what I saw from decades ago. So, everyone benefited. Similar to this asset class, the hedge funds that are buying up the houses, they don't have a good reputation in the market. I think they're often vilified, but there's a lot of good that comes out of it. Now, I'm supportive of, Main Street investing in Main Street, love that mission. But as the big institutional players have come into this, they've brought pension funds, they've brought life insurance companies, they've brought other hedge funds. And, it's not just to benefit them, but it also benefits the mom and pop investors as well. So, the property managers are serving them, are serving other clients as well. The lenders who are serving them are serving the smaller clients as well.
There were attendees here that had 2 or 3 houses. There are folks like you, Sep, that have several hundred houses. We met people that had 1,000 or 3,000 or 10,000 houses, but still, that's just a drop in the bucket. So there's lots of room to play and lots of places. Big thanks to Stephanie Riley and Sep Bekam for joining us today. Hey, if we have listeners that want to know more about what you guys do, what's the best way to reach you?
You can go to equitystrategiesteam.com and download free reports and learn about us there.
All right. If you're looking at cash out, Stephanie's written a great report that you can get if you send an email to cashout@realestateguysradio.com, cashout@realestateguysradio.com. That'll also give you her contact information. What about you, Sep?
Best way to reach me is to come to one of the Real Estate Guys events. So you got to come.
All right. There you go. Sep will be with us at the Secrets of Successful Syndication. In fact, he's the only person we know besides us that has been to every single one we've done for more than 10 years. Hey, big thanks to the folks from IMN for being such gracious hosts, for putting on this awesome event, and for having 3 of the 4 of us on panels. That was pretty exciting. You can stay tuned to the Real Estate Guys to know where we'll be next. You can find out about all the IMN events at imn.org. Until next week, happy holidays. Go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.